Hey folks, Rachana Ranade here and I welcome you all to an amazing video wherein I'm going to discuss about 3 gems of fundamental analysis. Well, believe it or not, I have done almost more than 1000 videos on our channel, but till date I have not done a separate video on these 3 gems that I'm going to discuss today. So don't forget to stay on till the end. But before I move on with the actual video, let me give a quick shout out to Siddharth and Ashu for the amazing comments. Well, before we move on to the specific 3 concepts in fundamental analysis, let me tell you that whenever I do fundamental analysis of any company, I check a 10-pointer analysis before I even filter out any company. And all these 10 parameters I've discussed in my course on fundamental analysis on my website rachanaranade.com. That's a special coupon code for you which you can use to get some additional discount. But if I were to give you a glimpse that out of these top 10, what could be the top 5 parameters, for that have a look at this. You can see that there is a specific point about market cap, there is something about revenue growth, profit growth, ROE and ROCE. Now why have I given market cap greater than 15,000? It means that this company, that whatever we are going to analyze, that is at least a mid cap. Okay, now how do we understand whether it's a mid cap, small cap? Again, I've discussed that in my basics of stock market course, but as of now you can remember this is kind of a benchmark. This is not the exact benchmark for 15,000 crores. Revenue growth, profit growth, is these are again some basic parameters. Higher the better is what we have to remember in our mind. Even ROE, ROCE, 15%, 15% are like the base benchmarks. Again, higher the better. So I hope all these all these 5 concepts are clear in your mind. But which are the 3 concepts that we are going to discuss today? Because I told you that I have not discussed these till date. These are free cash flow per share, and price to free cash flow ratio. If you feel that there are any other fundamental concepts which I have not yet discussed on our channel, please don't forget to leave a comment below. Now let's take a very simple example. Assume that there is a hotel owner and 1000 rupees is his revenue, collected amount based on sale of food and beverages. Now to run his hotel, he requires to spend 400 rupees. Right? So what is his basic operating income? I can say it will be revenue minus this operating expense, which will be 600. But wait, he'll also have to pay tax on that. How much is tax? Tax is assume 200 rupees. Okay, and whatever balance is left after paying out all the operating expenses, after paying out taxation, whatever is left is called as the operating cash flow. Now possibility number 1, he can use this entire operating cash flow for himself. He can withdraw it as cash. Possibility number 2, he can use this for payment of dividend to his shareholders. But there is one more important possibility, that if he wants to expand the business, or if he wants to renovate his hotel, let us say he wants to do some sort of capital expenditure, let's say in the form of new tables, new chairs. So assume that capital expenditure for furniture is assume 300 rupees. Whatever balance is left, this is 100, and that is called as free cash flow. In simple words, whatever money is remaining after spending for your day-to-day operations, after spending for your capital expenditure requirements, whatever money is remaining is called as the free cash flow. But this is just to give you an example. The exact formula and also how can we check free cash flow on Screener is what we'll check in the immediate next section of the video. Now we are on screener.in, and just as an example, I've used Jubilant FoodWorks. And how do we compute free cash flow? The formula is very simple. It's operating cash flow minus fixed asset purchased plus fixed assets sold. So we can say this is like net fixed assets purchased. Okay, so how do we compute that? For that, just go on to cash flow statement. Here you can see operating activities, right? So how much is this? 930 is what you can see. 930 is cash flow from operations. But from this amount, what do we have to deduct? We have to deduct whatever is the fixed assets purchased amount, and then we have to add back fixed assets sold. So for that, I'm sure if it is about maths, we are not going to do the calculation just orally. So let us compute it here. So how much is the cash flow from operating activities? It is 930 minus 654 is the fixed assets purchased, and plus, oh sorry, not 654, it is 391, correct? So 930 minus 391 plus 2, 541, and that is of course rupees in crores. But instead of me computing all of these things, can I get it directly? And for that, I'll give you one shortcut. So I'm again on the home screen of Jubilant FoodWorks, and what I can do here, there is one more option, add ratio to table, and here I can say free cash flow. Correct? Now if I say free cash flow, you can get multiple options. Assume that I'm doing free cash flow of last year. And if I just click that, ideally I should be getting it somewhere here. Free cash flow, correct. Here you can see it, 541 crore. Is that what we had exactly calculated? Answer is yes. So I hope you have understood using both methods, either this shortcut method, but I showed it to you at the end, otherwise we would have used only shortcut. So first I showed you how to calculate, and I've also showed you how to use the shortcut to calculate free cash flow. Now let's try and do some more analysis on this. Ideally, if you ask me, free cash flow, higher the better or lower the better? Answer is obvious, it is always higher the better. But just in case, if the free cash flow is negative, does it mean that I should not even touch the shares of that company? That's not the case. We have to understand 2 points here. Number one, whether the operating cash flow itself was negative, because of which the free cash flow is negative, or the operating cash flow was very much positive, it is because of the capex that the free cash flow has gone negative. That is the first thing we have to understand. Now, if operating cash flow itself is negative, ideally I would want to stay away from such companies. Okay, but if the company has amazing positive operating cash flows, but because of capex, if the free cash flow is going negative, I may be still okay with that. But again, there is one more question. Is it happening that it is negative for years together? That should ideally not be the case. If you are doing capex for, let us say, 1, 2, 3, 4 years back to back, there should be some point in time where you should get a feeling that, okay, now whatever capex I'm doing, that has started generating some revenue for me, and that is why free cash flow, we always say that maybe 1, 2, 3 years negative, it is still okay, not for an elongated period of time. Now, if I were to compare two companies, can I use free cash flow directly? Answer is no. Why? I mean, the scale could be totally different. The scale of operations could be totally different. And that is the reason why generally it is said that you should use free cash flow per share if you were to compare two comparable companies. Now, you might be like, there is one more ratio wherein I can use a similar comparison factor, which is nothing but EPS, and that is nothing but earnings per share. But it is always said that earnings may be manipulated, could be manipulated, but it is comparatively difficult to manipulate the cash flows. And if you have the similar thought process, then using FCF per share could be a better measure rather than using earning per share. But how do you check that on screener? For that, again, I'm going here. So assume I want to check for Infosys. So I just check Infosys here. Then I go to peers. Okay. I already have this, 1 minute. Let me first cancel this out and then show you. Okay. So if I go to peers, what you have to do is go to filters and just add free cash flow per share. Okay. See here you can see FCF per share. I've added this. Okay. Then I say save columns. Once I've done that, you will see that TCS has a free cash flow per share of 101.08, whereas Infosys has a free cash flow per share of 52.36. This clearly tells us that available cash, available for what? Could it be available for dividend payout as well? Why not? Could it be available for a buyback at a higher price? Why not? So whenever you want to get benefit of corporate actions, ideally, other than your reserves, your free cash flow also has to be strong enough. So you can clearly see that based on this, as compared to its peers, TCS has way higher FCF per share as compared to its peers. Before I move on with the third gem, don't forget to check out the question that I have asked you in the pinned comment. That will give you more clarity on the video. It will check whether you have understood the finer aspects of the ratio that I just discussed right now. Moving ahead with the last gem, as I mentioned, it is price to FCF. Now, what would this be similar to? This would be definitely similar to price to earning ratio, that is a PE ratio. Again, same logic. Many people say that it is, comparatively easier to manipulate earnings, but it's comparatively harder to manipulate the cash flows. And that is the reason why few analysts believe that rather than checking the PE ratio, one can check the P to FCF ratio. But should we be really computing that? The answer is no. It's readily available where? Let's go again to screener.in. And here I'm again on Jubilant FoodWorks. What I'm going to do is just type here price to free cash flow. Here it is. Okay. So what is the current market price to FCF for Jubilant FoodWorks? It is 56.5. And if I were to compare it with, let's say, Devyani International, remember 56 was for Jubilant. Here price to FCF is 113. So with this we can easily say that we would be paying a higher amount per share for buying one share of Devyani as compared to buying one share for Jubilant FoodWorks. I hope price to FCF is also very clear. Well, that brings us to the end of an amazing and an informative video. If you did like it, don't forget to smash the like button. Don't forget to share it with your friends and relatives. And like I said in the beginning of the video, if you feel or if you believe that I have still not covered some important concept about fundamental analysis, don't forget to leave that in the comment section below. If you want to learn more about PE ratio, you can click here, and if you want to learn more about CAGR, you can click here. Till then, take care. Jai Hind and bye bye.